Welcome back to our channel, folks. Today, we have an incredible story to share with you. Do you recognize this guy? That's right, his name is Rakesh Jhunjhunwala, often called the Warren Buffett of India. Starting with a mere $420 in 1985, he managed to amass a fortune worth $5.7 billion by 2022. That's an impressive compound annual return of 65%. So, let's dive into his inspiring story and uncover 6 valuable investing lessons that we can all learn from. First, let's learn a little about Rakesh Jhunjhunwala. Known as the Big Bull, he gained fame for his outspoken and relentlessly optimistic view of India's economy. His passion for trading began during his college years, and he later established his own stock trading firm called Rare Enterprises. Jhunjhunwala was a firm believer in conducting deep fundamental research. He once famously said, "A balance sheet is like a bikini, it shows more, but it hides what is vital." I learned to read a balance sheet, and then I got fascinated with stocks. His dedication to understanding the inner workings of companies played a crucial role in his success. Unfortunately, Jhunjhunwala passed away in 2022 at the age of 62 due to prolonged health complications. It's difficult to imagine what more he could have achieved if he had enjoyed the same long runway as Warren Buffett. Based on available data, Jhunjhunwala was the world's second-best investor, narrowly edged out by Jim Simons, who achieved 66% annualized returns during his career. Now, let's explore some of the investing rules that made the Big Bull so successful. Lesson number 1. Look for companies with a competitive edge. Just like Warren Buffett, Jhunjhunwala sought out companies that had a strong competitive advantage, making it difficult, if not impossible, for others to replicate their success. He firmly believed in the mantra of buy right and sit tight. Lesson number 2. Jhunjhunwala preferred to search for small-cap stocks and establish a position before they caught the attention of most investors. He cautioned against investing in companies with unreasonable valuations and urged people not to chase after companies in the limelight. Lesson number 3. It's important to remember that you don't have to be right all the time. Jhunjhunwala's track record shows that he made mistakes, especially during the dot-com bubble. However, what set him apart was his ability to consistently identify stocks with tremendous upside potential. These 10 to 50 baggers more than made up for any losses he incurred along the way. Lesson number 4. Jhunjhunwala's approach evolved over time. Initially considering himself a trader, he aimed to accumulate enough capital to transition into a long-term investor in undervalued companies. He believed that active trading kept him sharp and connected to the markets, something he truly enjoyed. Lesson number 5. Rakesh's success came from combining 2 seemingly opposing strategies, short-term trading, and long-term investing, and leveraging his returns with borrowed cash. He famously said, "I am always 130% invested," emphasizing the role leverage played in his remarkable success. Lesson number 6. Jhunjhunwala warned against blindly following famous investors' picks and trading based on rumors or speculation. He urged individuals to conduct their own research, rely on their own thinking, and develop conviction in their trades independent of pundits or famous investors. For beginners, Jhunjhunwala had some valuable advice. He considered investing a full-time job that requires continuous monitoring. He encouraged beginners to take their time, make informed decisions, and suggested dedicating as much time to researching a stock as one would to buying their first home. Jhunjhunwala often recommended books by Victor Sperandeo, also known as Trader Vic. Starting with a small position was another piece of advice he gave, as he believed that mistakes were bound to happen, and the markets could be merciless. Wrapping up, Rakesh Jhunjhunwala was undeniably one of the greatest investors of all time. However, what made him truly unique was his interesting relationship with money. He viewed it as a means to an end, not an end in itself. To him, money meant freedom from doing things he didn't enjoy. Before we go, let's leave you with some of our favorite quotes from the Big Bull himself. Markets go up not because there is an abundance of buyers, but because there is a lack of sellers. Markets tend to shake you up before a bull run. Growth comes from chaos, not order. Never react and change your investment decisions according to daily business news. Panic selling is a bad habit. I am not a clone of anybody. I am Rakesh Jhunjhunwala. We hope you found these insights from Rakesh Jhunjhunwala helpful and inspiring. Remember, Learning from the best can guide us on our own investment journeys. Stay tuned for more valuable content, and don't forget to like, subscribe, and hit that notification bell so you never miss an update. Thanks for watching, and we'll see you in the next video.